Hello everyone, this is Rahul Jakaria from Sharekhan. Welcome back to exciting 3R actionable stock updates. 3R basically means right sector, right quality and right valuation. These are our investment ideas. Today we have an update on Caplin Point. We retain positive view on Caplin Point as revenue growth is driven by higher traction in both US and emerging markets. Healthy order books and ANDS approval, hence the management is confident of clocking revenue growth of 50% year-on-year for the US market, which accounts of 15% of revenues, consisting of niche, high-value injectables and ophthalmic segments. Caplin is nearly completion of its planned Rs 6 to 6.5 billion capex outlay to enhance existing production capacity, widen product range and achieve backward integration for a majority of products. We see many visible triggers for growth in the near term that will lead to 16% PAT CAGR over FY23 to 25, such as strong LATAM growth driven by capacity expansion, launch of products under own label in the US markets, healthy pipeline for US markets, which filled 33 ANDAs, out of which 33 were approved, with a pipeline of over 55 products to be filled for the future. Change in business mix towards branded generic, currently 25%, and further expansion in the branded rest of the world markets. Hence, we have upgraded our EPS by 5% and 10% for FY25 and 26 respectively. At current market price, the stock trades at 21.2 times FY25 and 18.1 times FY26 estimated EPS. We maintain a positive viewpoint with an upside of 16%. Next, we cover NMDC. Our analyst maintains buy rating on NMDC with a revised price target of Rs 290. The company's earning outlook remains strong and has further improved given a steep price hike, 29% for lump and 36% for fines over September 23 to January 24, and robust iron ore sales volume, which was up 23% year-on-year in 10th month FY24. Quarter 3 of FY24 consolidated PAT at Rs 1672 crore, which is up 63% and was 8% above our estimates, led by a beat in EBITDA margins, higher other income, and rise in share of profit from associates and JVs. Management has guided for a strong iron ore production of 47 metric ton for FY24 and 51 to 52 metric ton for FY25. We expect NMDC to clock 17% EBITDA and 21% PAT CAGR over FY23 to 26, along with high ROA of 24%. Moreover, demerger of the steel business will reduce capital intensity and should lead to re-rating as financial remain robust. Valuation of 5.8 times FY26 CV by EBITDA is reasonable. Stock offers healthy dividend yield of 4% and it has high cash of Rs 11,500 crore or 16% of its current market capitalization. Next, we cover BOSCH Limited. Our analyst maintains buy on BOSCH Limited with a revised price target of Rs 31,045 on expectation of rising localization, increased content per vehicle and emerging opportunities in alternative powertrain. BOSCH has reported a strong beat in its operating performance in quarter 3 on account of a strong gross margin expansion on sequential basis. With a strong hold on gasoline, CNG and diesel, BOSCH is targeting to expand in the EV and hydrogen energy segments. The stock trades at price to equity multiple of 34.2 times its FY26 earning estimates.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.